This is a City AM Studios production.
Hello and welcome back to Business as Usual, brought to you by Okta, with me, Martin Kimber.
And me, Matt Kenyon. Coming up on the programme today, businesses despair as Britain is gripped with leadership uncertainty.
British businesses need to go harder and faster to compete with international brands. That's according to new research from Kantar, and we speak to their senior director.
Plus, the housing market and the construction sector are being pummeled by geopolitical instability. But first, the long, protracted fall of Sir Keir Starmer is causing major problems for businesses around the country. Simply put, no one really knows exactly what or when to expect things to happen and to change. So it looks like by the time that you listen to this, Wes Streeting could be on his way to resigning. He may already have resigned, and he looks set to fire the starting gun on a bitterly contested leadership election. If it happens, the process could last months. So if you're looking to make any kind of investment decision for the rest of the year, well, good luck. Joining us to make sense of this whole mess is our senior city reporter and bond market bombshell, Sam Norman.
Wow, that is a compliment and a half, Matt. Thank you very much.
The very opposite of a Bond villain.
Wow. Well, if anything, the Bond villain right now, it could be Wes Streeting.
It could be Wes Streeting. It could be someone on the other wing of the Labour Party. I suppose just to take us back to Wednesday, when it became clear after the quite dramatic, brief showdown in Downing Street that he was potentially going to make a move. What was the immediate reaction in the markets when he did that?
So I think it came at a very weird time. So it was minutes. We're talking 10 minutes before the King's speech properly really began. But I mean, they'd already started entering the chamber. The King was, I think, had already arrived in the Commons by that point. And then reports started coming out. So I think it was the Times.
It's not a great look, is it?
It's a very bad look. The Times, I think, broke it first. And it was Wes Streeting is going to resign by the end of the week, as early as tomorrow. So that's obviously Thursday. And I mean, the instant reaction was for the bond market. I think it was about a 2 basis point move up. Now, that doesn't sound a lot, but I think when you put it into perspective, this morning they were actually easing ahead of the King's speech. So we saw climbs of 10 basis points across the 10-year and the 30-year yesterday. This morning, they were easing back down, albeit modestly. But then to go from dipping straight back up and then into a good 2 basis point gain, it's obviously a sign of instability.
And is that because the bond markets, essentially the people who lend the government money, are afraid that whoever replaces Keir Starmer would be a little bit looser with the fiscal rules? I mean, we had Ali Lyon's article do very well recently where he said, we quoted a Labour MP who said that the bond markets should fall in line behind Andy Burnham. So does this sort of scare kind of institutional investors a bit?
Yeah, I mean, of course, it's going to provide them that fear because it's the uncertainty at the end of the day. They don't know who would Wes Streeting's Chancellor be, what would his fiscal policy be, but also would it be Wes Streeting? If Wes Streeting is going to kick off this leadership contest, it's not necessarily a reflection of him, this uncertainty. It's the fact that there's going to be a contest. Just because he's kicking it off doesn't mean he's going to win, but it also means there could be this entry of this soft left candidate. It could be an Ed Miliband or an Angela Rayner, who we know for sure is going to have this looser fiscal policy. So it's not necessarily a reflection of Wes Streeting and how he would govern. It's more of the uncertainty of like, oh, we might actually now see a changing leader.
And there have been reports in many newspapers, including our own, that the ultimate cost of this uncertainty could be something like £12 billion. And I suppose there's the cost in terms of all the business decisions that are sort of left, but then there's also the cost in terms of the markets. What do you think the ultimate cost of this could be?
Well, it all comes down to Rachel Reeves' headroom. I mean, we saw that at the last budget. She built up that fiscal buffer, and it came back to, I think it was just over £23 billion. We're getting this £12 billion figure now. That could be half of her headroom gone, and that's before we even start talking about Iran.
Well, last week we had Mauricio in the studio who was saying about 12 billion was going on.
So that's the whole thing.
Iran inflation. So there we go. That's it. We've spent it.
And this is a government that's already now said, we're not coming back for more. We're not doing more tax rises. Obviously, we saw 26 billion last year. That was on the 40 billion the year before. And the idea was, I've got this extra headroom now. I've built it up. Like we've done the tax rises we need to. But then Iran happens. Then the bond market troubles happen. I mean, what the headroom is now, I mean, God only knows. But
Sam, can I take you to your banking and financial services beat
My
for a moment and away from the tribulations of Westminster to talk about a bit of the the King's speech itself. So the King brought up the Enhancing Financial Services Bill, which by the looks of it is about kind of unshackling and untethering the government and financial policy away from some of the hangovers of 2008.
I hear the King's very passionate about that.
Sure is.
There was sorry, this is a bit of an aside. There was a brilliant bit of sort of someone tweeted that it's an absolute crime that the King should be saying things like "at pace" and sort of repeating Starmerite language in Hansard in that way. But I suppose what do you make of some of the financial services reforms going on?
It was a big wet flannel. Like there was
You're not impressed?
There was nothing in there of substance. Listen, over the last couple of months, I've been at a lot of these events where just last month I was at the Innovate Finance event where it was this big fintech growth package was announced. Two of the key policies there were already ones that had been announced, and they've also been re-announced today in the King's speech. It's like we've had these. So let's take the merger of the FCA and the PSR, two different regulatory bodies being merged together into one. That was announced a year ago. We've had so little progress on it. It keeps getting re-announced, and little bits of progress here and there. We had last month. It was like we're going to bring them together to streamline fintech regulation. Then today we're going to legislate for it. Now, obviously, it needs to be legislated for. But if this is not a big dial-moving regulation reform that we are expecting, like this is something we've known for a year now. Why is this the big announcement that's coming from the King's speech? And there's a few other things like that as well, but that's just one. It's the lack of new big levers to be pulled is probably quite disappointing for the sector.
Just to bring it back to the kind of Keir Starmer's leadership sort of catching fire, flipping upside down and sinking as it's doing at the moment. That exact criticism was something I heard on the radio recently where an MP was basically saying, like, it has taken ages to get any kind of legislative action going. And I get it, like running a country is turning around an oil tanker and blah, blah, blah. But that seems to be a quite a regular bit of criticism that you hear from everything from banking to violence against women and girls and stuff like that. Like, they're just not being radical enough, fast enough. And I don't know if the country can be.
See, this is the thing, like, we saw that. If cast your minds back to last December, Keir Starmer was in one of the select committees, and he was literally saying, every time I go to pull a lever, there's just red tape surrounding it. And it was the first time you almost saw, like, authentic frustration from the Prime Minister, and we understand it. Like,
but that is also, given how centralised power is around the Prime Minister and literally no one else, an insane thing to say.
But then let's just connect that with Jess Phillips's resignation statement this week, and she was literally like, cause more rows, be more boisterous, pull more levers.
Yeah, don't be terrified of consensus.
Don't be scared of things. So it's his frustration going back to December is still tracking all the way through to now. But even one of his own ministers is resigning because he's not just being boisterous enough.
One more thing for you, also on banking. Jamie Dimon came out on Monday, makes quite a dramatic threat that suddenly we might see this £3 billion investment, which involves obviously a skyscraper, which could have £10 billion of surrounding
that office
impacts.
looks like it's going to be like the Disneyland of banking.
Yeah. Like, same height as the Shard. He's threatening to take that away if the uncertainty around bank taxes crops up again. What do you make of this? Because this is worrying, because it seems like simultaneously we've got ineffective Starmer plus maybe overly effective soft left imagined leader next.
We cannot even put into words how much of a blow that would be to Rachel Reeves. Like, put it this way, when Rachel Reeves was going out on the media round and selling her budget last year after as we said, this £26 billion in tax rises, what she was mentioning every media round she was on was, but look at all the bank bosses who've supported me this morning. Jamie Dimon announced that in the aftermath of the budget. No coincidence whatsoever that the banks didn't get taxed in that exact budget. And then she could turn around to every presenter and say, well, did you disagree with Jamie Dimon, who's just announced this big investment? And she did literally say that on, I think it was
probably
Sky
her
BBC.
most successful PR move.
And it was a
time in
fantastic
Treasury.
line to have. Well, what about Jamie Dimon, the world's most influential banker, who's just bet on the UK because of my budget? If that goes, that is the complete rug pulled out from underneath. And obviously we don't know. Reeves obviously has shown she's very hesitant to go tax the banks. But it might not even be Reeves who faces the brunt of it if they bring in another chancellor who is hostile, as Jamie said, to the bank. So they then would have to deal with the consequences of that. But
well, just for time reasons, we're going to wrap it up there. But I will mention, you compare. I've just looked at the telly, and Downing Street has full confidence in Wes Streeting. It says, well, when it looked like Robert Jenrick was going to resign from the Conservative Party, Kemi Badenoch dealt with that in a very, very different way. So maybe Sir Keir can learn something.
Also, she's already been in the studio. You don't need to do this.
Her presence is still felt. Thank you very much, Sam.
thank you very much, guys.
Cheers.
Right, so coming up after the break, the Iran war and geopolitical instability around the world is causing big problems for the housing market. And we talk to an expert from Kantar about what makes a great British brand and cut through. This episode is brought to you by Okta. AI agents are everywhere now, quietly making decisions across organisations. That's great until you stop and think, who's in charge?
If you don't know who an agent is, what it's connected to, or what it's allowed to do, you can't really trust it to act in your interests. That's the bit Okta focuses on. They secure the identity of AI agents, so there's one clear layer of control across the whole system.
Which means every agent has a clear identity, permissions, and a line of accountability, even as things scale.
Risk becomes something you manage, not guess at. Secure every agent, secure any agent. Okta secures AI.
Welcome back to Business as Usual.
Now, here's one for all the marketing geeks out there, because British brands might be falling behind the rest of the world. According to data out this very morning from Kantar and the University of Oxford, British businesses will need to work harder and faster to make sure they keep pace with those from overseas to maintain their standing with consumers and clients. The findings also show that companies with particularly strong brand equity deliver abnormally high share price returns, even outperforming the S&P 500, and have a greater resilience to crisis and uncertainty. Well, joining us now is Peter Aitken, a senior director at Kantar, who conducted the research. Why don't you start by explaining why you conduct this research and why Britain seems to be falling behind?
Thank you. Well, thank you for having me, first of all. So we've been doing this research for over 20 years, and it helps us to understand the brands that are performing in the market, but also the ones that are most likely to grow. And as you said in the intro there, by understanding the perceptions that people have of companies, that's a very strong predictor of their likelihood to grow over time. And we found that over the period that we've running, these stronger brands have outperformed the S&P 500, the MSCI World Index. So brand strength is an irrefutable predictor of growth. But your question here around British brands and the makeup of this, we've certainly seen an increased dominance of the US brands from the US and from China making up this. So now the US brands make up just over 80% of the total value of the top 100, and we've seen a huge growth of Chinese brands in there as well. They've grown 31%. So we're certainly seeing that the volume of scale that's created, and the value that's created is increasingly dominated by US and Chinese brands.
I'm really intrigued by some of the data about particularly Chinese automotive firms, because back in the day, if you were a company like Geely, when it first wanted to enter the British market, you buy a brand like MG and you use that because you build on the familiarity that already has. But now BYD, it's on your list. I know that we had some reporting out this morning about how there are more BYD cars now than there are Land Rovers in the UK. I suppose what's been the shift that's sort of made that cultural uptake more kind of acceptable to the public?
So BYD are now the fifth most valuable car brand in the list. So, there's still a lot of other big brands ahead of them, Toyota, for example. But what we've seen in the UK is the growth of Chinese brands and their increase in market share. They've gone from sort of single digits, 1 or 2% a few years ago, about in 2020, up to about 10% of market share right now.
Just very, very briefly, what is the quantitative process you go through to quantify exactly the value of a brand? Like, how would you, for example, try and quantify the brand of business as usual in partnership with Okta by City AM? How would you go about figuring that out?
I can't see it on the top 10, but I might have an out-of-date list. I won't put that against
Right.
you.
So firstly, you want to understand the total value of the company, and that is everything, including its tangible assets, its intangible assets. That's everything. It's not just market cap, but it's the future growth projections based on analysts.
Matt and I are the only assets really in this.
That's interesting. So what are the? How do you measure intangible assets?
Well, so what we're doing what the brand value will look at is it will take out all the tangible assets, but also take out things like IP as well, and it will just look at the consumer perceptions of the brand and the extent that contributes to the total value.
So do you poll people? You ask people, like, have you ever heard of
Exactly.
Toyota?
So we've been running the same standardized study over the last 20 years, and so it gives a really strong base for understanding that growth over time.
And the only British name that you said is sort of still on this sort of power list is HSBC.
Yeah.
Why is that?
HSBC are a huge brand globally, huge in the UK. And so brands that make the top 100 they do a number of things. Firstly, they appeal to a huge range of people. We call that being very meaningful. They also stand out as offering something unique, seen as different, but they have to do that on a global scale, and that's what HSBC have done incredibly well over the last number of years, and that's kept them in the ranking.
What sort of advice would you give CEOs and CMOs listening to this about how to sort of elevate their brand equity?
Brand equity is formed on three characteristics. Firstly, the perception that the brand gives you something that you want. We call that being meaningful. Second, that it stands out. It offers something that's seen as unique in the category. Offers something that others don't. We call that being different. And also, it comes to mind quickly when you want to buy something in that category. We call that being salient. And so growing, you need to deliver on those things. You need to recognize what's important for customers, but you also need to do that in a way that seems unlike any others in the category. And that's what BYD have done really well. They recognize that British buyers want low prices, but they also want quality. They want good engineering. And that's why they've managed to grow, growing at a strong rate in the UK at the moment. But equally, that's what British brands have been doing for a long time. They recognize what customers want, and they do it often in a way that feels different, but just not necessarily at the same scale as we're seeing the likes of Claude and Google and Apple.
We've spoken quite a lot about the companies at the top of the list, but I suppose sort of lower down the rankings, are there any particularly promising British brands that you're seeing rising up at the moment that you think actually could be in the upper reaches given a few years?
Yeah, I mean, it's about creating the conditions for scale. So Britain is not short of great innovation, great creativity, engineering, entertainment. So we see F1 and all the F1 teams. We see the Premier League. We see Burberry, the BBC, Dyson. So Britain is not short of talent, innovation, engineering capability. The challenge for Britain is scaling that. What we see in the US and the conditions that exist in the US, Silicon Valley and Shenzhen in China, they create the conditions to have a much greater ecosystem for these brands to grow. The challenge for Britain is taking these local heroes and allowing them to grow. And we're seeing in the UK greater investment, for example, in the Oxfam corridor. We're also seeing the Rachel Reeves trying to push for greater retail investment in UK equities. And so what these businesses need is they need the conditions for scale, and that's increasingly what Britain needs to get right to enable these things to happen.
Well, Peter Aitken from Kantar, thank you very much for coming in. We look forward to seeing Business as Usual, sponsored by Okta, on your list next year in at least the top 20. Do you think we get it to the top 20? Okay.
Challenge for 2030. Let's go.
2050 maybe.
Thank you for coming in.
And finally, if it feels as though our outlook on the news and on the world has been a little gloomy today, well, here's a little bit more volatility for you. Because it looks like the geopolitical instability from the war in and around Iran is hitting both house prices and house building. That's according to brand new data, which our retail reporter Felix Armstrong has been writing all about. Welcome back to the podcast, Felix.
Hello, Matt. Yeah, that's right. So it just seems to be getting worse for house builders and for house buyers. We've got the Royal Institute of Chartered Surveyors report out on Thursday morning that shows that indicators of sale expectations is at a negative 32% by their index, showing that inflation expectations due to the Iran war are making people just feel that they can't sell now because they just will not get good mortgage conditions.
It's quite bleak. So is it? It's not a builder's market, and it's not really a buyer's market, but it's also not really a seller's market. So it's not really, the sort of instability is adding to an already quite bleak picture that we've seen building up over the last few years anyway.
Yeah, and the house builders are suffering from that too. We had Vistry on Wednesday. Their share price was down again because they said they're going to take a big profit hit from their measures that they're doing to try and balance the books. They're cutting prices and they're slowing down on land buying, as are basically all of the big house builders at the moment.
I mean, the banks are trying to desperately revive the housing market with sort of £5,000 deposit mortgages and like £10,000 deposit mortgages and stuff. I mean, like, until we tackle stamp duty, is there anything that anyone can really do to juice the housing market?
I don't know. I mean, I think the mortgage rate situation did stabilise a little bit. It was complete chaos towards the start of March. And some of the actions taken by banks have worked a little bit. But I think you're right. I mean, especially in London, what I'm hearing from industry figures is that stamp duty is just making the situation in the capital the worse it is in the country.
We really are gripped by gloom in here at the moment.
I was about to make it worse. I was going to say, higher interest rates obviously also means that sort of buy-to-let landlords are also going to raise rents considerably on renters. So it's not just homeowners; it's also leaseholders.
Yeah, and if you wanted a little bit more gloom, you could
Take
point
it a level deeper.
you could point to the Renters' Rights Act, which some industry figures say is going to slow demand for new flat developments as well.
Actually, on which note, because I think there is one case you made that we need to see a lot more new flat development. There is actually quite a lot of emerging reporting at the moment, and there was a really fascinating piece in the Telegraph about this the other day, about the difficulty in actually selling any of these flats once you've moved into them because of these rapidly rising service charges. Have you looked into this? Because I think this is insane, this idea that people can sign on or buy these flats, start with a sort of what feels like a very expensive £3,000 service charge, and suddenly you're paying £10,000 and there's no legal recourse to stop it.
Yeah, I mean that is definitely the case, and I think the government has said it plans to kind of tackle service charge, but I don't think it's kind of put through completely meaningful change yet. There was something on that in the King's speech today, I believe, but I mean it just, with the Iran war, seems to just be kind of adding to a pretty tough situation that was already there.
Well, I wish we could leave you with better news. I mean, maybe tomorrow we can find a sort of cycling dog or something as our end.
Do you have anything optimistic to say? Like at all? We've been short on smiles, haven't we?
Yeah, not a lot of laughs.
You've got nothing.
No.
I went to a pub in the Square Mile the other day that had a £4.60 pint.
Okay, no, that's brilliant. That's brilliant.
Excellent.
So you can have that.
Well,
yeah.
what fantastic news to end on, and he'll be writing that up, I'm sure. £4.60.
Lots of data.
Well, that's all we have time for today. Thank you very much for listening to Business as Usual, brought to you, as ever, by Okta.
Don't forget to subscribe to City AM's various daily and weekly newsletters, and, of course, to download our free app.
It's a really good app and has puzzles. So, we'll be back in your podcast feeds tomorrow at 6 a.m. But for now, goodbye.
Goodbye.